All right, I think we'll get started. So thanks for joining us. A lot of you I know, others I don't, and welcome to you. I think we're all kind of here for the same reason. It's a very noisy market at the moment. There's a lot of factors that are kind of buoying it up and weighing it down, and it's a hard one to read. So I guess the purpose of this panel is to try and distill some of that noise and tap into the experience of the panelists here to work out what's important, what's going to move the dial, and what we can ignore. So obviously we've been seeing meme coins extract a whole lot of liquidity out of the market, trade wars, slowing economies on one side, and then we're seeing some really positive things on the other. So what I might do is I'll pass to the panelists to do an intro. The way this is structured is the first half is kind of going to be a discussion on the macro environment, where we are at the moment, and looking into whether some of those models still hold. And then the second is going to be more freeform, the kind of individual factors that are the tailwinds and headwinds. So on that, I might we'll work our way along, and you can introduce yourselves.
So my name is Mark. I'm looking across the crowd, and no one here from my old jobs were going to turn up to say, I told you so. Why did you leave commodities and join crypto? Well, I think we're still, at some points in days like today, it can be difficult. So I spent 25 years in markets, mostly in commodities. Started as a research analyst, went to business school, was a banker for 7 years, worked in private equity for 6, started a business, ended up coming back to Australia with Macquarie and spent 4 years with Macquarie on their commodities team. Better or worse, I met Luke, and we said, why can't we do what we were doing previously? He was at Platinum and other hedge funds. I was at Denim. Denim had 350 investors, $10 billion, 6 funds. Why can't we do what we did there and do it for crypto? That was 2021. We ended up launching the fund in 2022, 10 days before FTX blew up, which you'd think that was terrible timing, but reality was it was probably better than if we launched it 3 months earlier, because we'd be deployed. So we kind of rode that wave fine. But yeah, so Luke and I started that in October 22. We're coming up on 3 years. It is a true alts fund. So it's been a rough couple months, but there's periods where it's been absolutely incredible as well. So we're not going to pitch the fund today. You can scope that out yourself after you go home. But yeah, that's my background.
Afternoon, everyone. My name is Jamie Coutts. So I'm the chief crypto analyst at a financial content platform called Recession. Before that, I predominantly worked in equities. So I started here in Australia, then in London, Singapore for quite a few years. I was in Singapore for 14 years on the sell side, but also at a macro hedge fund. Moved to Bloomberg and did various things on the technology, sales, and product side. And I guess how that all relates to why I'm here today is that whilst I was there maybe sort of 17, 18, well actually 16, but then it really ramped up in 17, 18 and 19, especially during the bear market. I started to really dig into the asset class. I guess I didn't fully appreciate what the asset class represented in those early years when I was trading it and not taking it seriously, but that all changed in the bear market, thankfully. And I owe a lot of that to Raoul Pal, who obviously is the founder of Real Vision, and now working with him is a wonderful experience. But it was at Bloomberg where I put together I'm not a research analyst. I'm actually, I would classify myself more of a trader. I've built quantitative trading systems in the past, and also done various other things on the buy side and sell side, but not research per se. I wrote a report internally at Bloomberg, made its way up to the grey hairs on the board, had a management call where they basically just, to use the expression of the monkeys flinging at me, or at crypto, I should say, not at me, I shouldn't take it personally, but it was a fantastic experience, because out of that, even though it was a baptism of fire as to why crypto is a scam and why they shouldn't care about it, it led me to create the crypto strategy group within the Asia Pacific region in 2020 and 2021. And then I transitioned from there into Bloomberg Intelligence, where I started the crypto research product. And the way I try to look at the market is simply through a multidisciplinary type approach. So there are indeed fundamentals for crypto. Everyone's just trying to work out what they are. So I use a macro-driven with a synthesis of fundamentals, technicals, and also quantitative processes to try and guide investors in the space.
Thanks, guys. I'm Luke McFarlane. My background of about 17 years in financial markets. Started in Melbourne, moved to the States for 8 years. I worked for Macquarie on the sell side for a couple of years before jumping onto the buy side. I ran money for Millennium Management in long-short equities, and then Balyasny Asset Management. And then I moved back to Australia, and I joined Platinum Asset Management before leaving there in 21 to come out and start Vikara. Our thesis for Vikara was pretty simple in that you can manage your own Bitcoin and Ethereum exposure. You can have those debates with people on your own. There are great technology solutions that are increasingly deciding to take that decentralized ICO path for capital and to build their business. And we wanted to add some value around the fundamental way that you could look at those tokens and the businesses that they were building and their potential utility through time. So far, we've not been rewarded on that thesis, but there's still very little dispersion across alts, and through time, our hope is, and we expect that there will be more dispersion.
And myself, I've been with Independent Reserve since middle of last year. I was in startups for a decade before that, and followed my kind of hobby into it. For those of you that don't know Independent Reserve, we're one of Australia's longest running exchanges, been around 11 and a half years. Got about 400,000 customers in Australia and beyond, really doing a big push into Asia and seeing a lot of positive motion across there. So that's me. I think Jamie's got a couple of slides that are useful in setting the scene. I think we'll sort of weave in and out of those as the questions allow or come up. But I think the one that we should definitely address is his first one on kind of where are we from an economic cycle point of view. So over to you, Jamie.
So
I'll just quickly address the elephant in the room, and that is concerns about recession. So, it's curious how markets tend to lag financial conditions, and this is a chart that actually comes from the Global Macro Investor product which is like a sister. It's Raoul's original product. And what we're tracking here is the Financial Conditions Index, which is really a synthesis of a couple of different things: rates, dollar, and other measures. And there is a lag between sort of the economic surprises, but also markets as well with financial conditions. And what we saw in Q4 was an anomaly, I think, to the extent of the overreaction to Trump's win, given the backdrop was we were seeing financial conditions tighten. The dollar, or the DXY, had run from 100 to 110. But markets were rallying hard on the back of the euphoria around the new administration and the new regulatory environment we were about to embrace. Now, conditions have actually started to ease considerably since January, but you wouldn't know it by looking at the markets. Again, there seems to be this lag. Now, will these lags or would these correlations hold into the future? We don't know, but we're judging based on sort of probabilities. When you start to see rates at 4.8, now at 4.2, the DXY at 110, down to 103, and I've got another chart if we get a chance, we'll get to it. That decline in the dollar that we've seen in March is one of the largest, fastest moves. And if you look back in time, probabilistically, that has always led to higher risk asset prices 90, 180 days, 365 days later. So what we're seeing is conditions improve under the surface. The dollar is really the hinge on all risk and sentiment and also liquidity. If you look at things like global M2, it's all denominated in dollars. So, as long as the dollar is declining, you can see rising liquidity levels, even if credit creation is not booming. And there seems to be this correlation with risk assets. And of course, there's lots of critics on Twitter about using global money supply as a metric, but if you look at that correlation, it's there. And I've dug into what global money supply has been doing based in local currencies, and it has been expanding over the last 12 months. It's just that the dollar has been tight, and that is a severe drag on global liquidity and financial conditions. So I guess to summarize it, actually, I think we're looking at a market that could potentially be higher over the next quarter. And I've sort of made the call, which I'll be hung out to dry if I'm wrong, is that I think actually we'll see new all-time highs in Bitcoin by the end of the second quarter, based on the amount of easing that we've seen already in the past month, 2 months.
Maybe for my benefit as much as anyone else's, can you explain how markets are impacted, just at a really high level? You know, when liquidity comes back into the market, when conditions are easing, how does that actually translate to better prices for Bitcoin? Luke, do you have thoughts?
I mean, I want to take the other side of this chart, to be honest.
Okay, Jamie.
Most of the improvements you're seeing in the economy are industrial-based, the manufacturing improvements. It's about 35% of the economy. From a consumer standpoint, everything's getting worse. Retail sales are rolling, discretionary spending is falling, like your desire to go on holiday surveys are getting worse and worse in the States. Like people have had they're as negative as they have been for a long time as a consumer. And so given that that's the lion's share of economic growth in America, it's just very hard to see that that part of the economy is getting better. The ISM, what it fails to recognize probably is there's a lot of pre-buying happening in that ISM because people are petrified of tariffs. And there's a lot of nuances there around how quickly I can get my raw materials that I need to make before Trump prevents me from getting them. And so, you know, seasonally, I'm completely with Jamie. It's a big euphoria around Trump getting in. It's good for business. It's going to be great for everybody. But every morning we wake up and there's something else to deal with that may or may not impact my supply chain. And the only way to get around that's to order today, order quickly, and order more than you need to. A lot of that's this chart. Now, that doesn't mean that things aren't going to get better for our sector, because you need the US to slow down for rates to come down so that we can refinance, so that we can actually get back to being a private economy-led GDP growth as opposed to a public economy, which was, you know, Biden spent so much money that it didn't matter that the average private business was in the recession or shutting down or having issues because the government was paying for everything else effectively. So, I'm of the view more that Q2 is an air pocket, and you see basically Trump and percent be incredibly staunch for the next 3 or 4 months until the Fed changes its mind on what it's going to do with rates. And that's the opportunity where things can start changing for us. But maybe to answer your question, as liquidity comes back, financial markets feel more buoyant, your ability to take risk is better. Theoretically, your outflows from interest rates are lower, and so you've got more discretionary capital, and you eventually take a risk with that capital. And historically, some percentage of that's flown into digital assets.
And this question for both of you: what kind of leading indicators, or what are you looking for to see whether your predictions are playing out?
Price. Yeah. So I mean, I think markets are forward-looking. So we're in a tight spot at the moment. Markets sort of pricing in a lot of fear. And to your point, there's absolutely front-loading going on in the industrial production numbers, and there's sort of sandbagging that's definitely occurring, and that's going to distort the numbers somewhat. All of this, though, achieves what I think Trump and Besson are setting out to do, which is just get rates down and allow homeowners to feel a little bit wealthier because their interest payments have been reduced, and also for the US government to refinance that $9 trillion that's due this year in the first half of the year. So I think they're throwing the kitchen sink at it to try and do it. And so far it seems to be working. Now, I don't buy into necessarily all the 4D chess stuff that gets discussed, but there is a strategy at play here, and Trump being Trump does want to get re-elected and does want to win the midterms, which are only 2 years around. So it's a little bit of second guessing what they're trying to do, but in terms of that strategy, but ultimately, if the dollar is weak where it is globally, that is acting like a massive release valve for the global economy. And then back at home, your homeowners, those paying mortgages are starting to see the benefits of lower rates also flow through.
Okay. So is it fair to say that the two views are, one is that the economy is following liquidity, in Q2 we're going to start to see that pick up accordingly, and the other is that Q2 is going to be a bit of a nothing, sideways, maybe even down market, and then and it takes a bit longer to turn things around?
Yeah, like Trump wants to encourage private investment into the US. You've had all of these guys come out and say, we're going to do 100 billion, a trillion, whatever the numbers are, right? But those projects take time. You've got to go and get scoped out. You've got to move the money. You've got to get people working on those projects. It's going to take a couple of years to see the benefits of those projects. And so there is no doubt that in 2 years' time, my view, America is doing much better than it is today. But to your point, that's a huge pile of debt that you cannot refinance with a 4 handle on it, and even maybe a 3 handle on it, because China's borrowing at 2 and change at the minute. Europe's, not a lot higher than that. It's like, why are you going to sit here as the US and be held accountable to the highest interest rates in the world when you need the opposite to actually keep your economy growing, to keep your government solvent, and to actually go and finance a transition from a government spending model to the private sector? So it's a game of chicken that they're playing, and it's really, really well, because every one of us wake up every morning, we feel worse about Trump being elected, and you feel worse about, our role in the world as a function of it. But that's exactly how we need to feel for someone to break, and that's what, it'll be interesting to hear what Powell says when he speaks tonight, and how their rhetoric changes, because in my view, they will, and they have to actually acknowledge that this uncertainty will delay that private capital being invested. It'll delay those timelines, and that air pocket can potentially be long enough to actually scare people into a US recession. And at that point, we'll see them change, is my view. Yeah. So I don't know when that is, to be honest, but it'll be at some point this year.
Yeah, sure. Interesting. And that's maybe a good segue into some of the more specific issues that are facing the industry. But first, I think, are there any questions that anyone had about the macro side of things, about liquidity or business cycles, before we move on? Ian?
Just the difference between the US and, say, China. What's the cause of that?
Yeah, it's a great question. Inflation's a huge component of it. Solvency is a huge component of it. And ultimately, the ability to repay that debt's a big part of it. Right now, I think the US has been overspending its budget, and you've had a lot of worries in the bond market that the Fed has not been able to, or had the tools to control inflation in a way that you can allow them to actually get rates back down again. And then Biden's been running such deficits that you haven't had any certainty that in 20 years you're ever going to get paid back if you buy a bond from the US government. And then lastly, it's demand ultimately for that instrument. China's stopped buying US bonds. Europe is, indifferent as to whether they own them or not. And really, the only buyers of US bonds these days are stablecoins. So it's a function of all three things at once and moving in a different direction.
Are there any others on macro?
Looking at the chart, how far back is that correlation back tested?
I think they've done it back to like 2021. So it's really
The way in which Bitcoin started to become more intertwined with liquidity factors was more obvious from 2019, 2020, with the largesse that happened at the fiscal and then at the central banking level. So it's been following through pretty well as well. Like, I've done regressions on a lot of these different metrics, and you go back in time, they're less strong over the full time frame, and they strengthen over time. Maybe they break down, but like the last 5 years, the relationship's been pretty good, pretty tight.
I mean, that was one of the questions that that I was going to bring up as well. Is these models tend to evolve as new information comes in. For a long time, it was the halving cycles that you'd have this run up after the halving, and then that narrative kind of shifted towards liquidity. Is there a point, is this, in your opinion, the sticking narrative? Is this what does drive the markets? Is there anything else that will factor in over time?
Yeah. I think historically the 4-year cycle, yes, has been driven by changes in the business cycle. And historically you could go back into 2011 and talk about peak China, and that's what caused the top. And then in 14 it was peak oil. And then in 18 you had a whole host of Trump's trade issues coming in, and there's peak global trade, and I think the best thing that can happen for our space is that the 4-year cycle dies and we all accept that it is actually driven by the macroeconomic situation, the liquidity, the GDP growth of the globe, because then we can get back to fundamentals in the space. I think in a large degree, like what are we doing? What are we solving for? Why is it good, bad, or indifferent? Bitcoin's a great example. So the last 12 months, have we had a Bitcoin cycle, or have we just seen Michael Saylor buying, global reserves setting up, regulatory overlays, and ETFs? If you ripped all those things out, Bitcoin would be doing exactly what alts are doing right now, which is they've succumbed to a global tightening bias where the Federal Reserve's still tight, the private economy is not doing any good, and government spending hasn't been flowing through to the digital economy. So I actually think, and altcoins are perfect. You've got a great chart on altcoins. They just go down every day, and we're still buying them. But that's okay, because the conditions that are required to have a bull market in altcoin are not there yet. They haven't even started a cycle yet, and that includes Bitcoin too. And I think Bitcoin will still benefit from all these tailwinds when they come, but we need to actually have that macroeconomic cycle change first.
The only thing I'll add to that is that the 4-year cycle, which originally was framed around the halving cycle, just coincided with the debt refinancing cycle of governments, especially the US government. So this year is a big year. They've got a refinancing cliff that they need to meet. So until that changes, and I don't see that changing. So governments refinance debt, they usually do it on a 3 to 5 year tenor. So that's how the 4 years, it's not perfect. We've seen an elongated cycle this time round. So as long as you have that structure to our global financial system, which is structural deficits in the US or in every Western country, need to get refinanced, and they need to maneuver rates down as much as possible, which used to be through very sort of clear, it used to be through the mechanism of interest rates, then it moved into quantitative easing. Now it's tinkering with all sorts of different facilities, but that go by every other name other than QE, which are QE or yield curve control. This is the game they play because they are literally backed into a corner. This is the structural state of the global financial system. And so that's expressed when the cycles turn, they're expressed in risk appetite. And then you've got, so that's my two big sort of thesis for the asset classes, the macroeconomic liquidity aspect, and then just adoption. And Bitcoin is being adopted every cycle. There's a new cohort of players that come in and buy it. Now on alts, that hasn't been the case, and they've struggled to get that traction. But long term, is the thesis still there for me? Yes, it is, but it's clearly not playing out in terms of the adoption rates. Although some of the adoption rates look pretty good, but Bitcoin seems to be in a league of its own because of the adoption, and now it's less about the on-chain activity with Bitcoin. It's mainly off-chain activity with ETF buyers and corporate buyers, swooping it up and not using the network much for its payment processing capabilities, which was a feature of the first 10 years of Bitcoin. But nevertheless, it's adoption by any other name.
Yeah, I'll just add one thing. I think you end up having a bit of self-fulfilling activity in this space. So, I'm sure you all have Twitter, and you probably all have crypto Twitter accounts, and you follow, and everybody seems to be very herd-like in this. And then, we were running our own money in 2021, and I think 2 months ahead of November 21, Luke and I were saying to each other, it's getting out of control. And you could watch the momentum and the frenzy of the space get out of control. And, we didn't get out perfectly in 2021, but it happens again in every one of these cycles. It's a retail dominated space. To Jamie's point, there's been very few institutional funds or, pension funds, endowments, super funds, some sovereign wealth, but they buy Bitcoin. So it's still largely dominated by people who are trading behind their screens, and you're not getting $100 million checks or $500 million checks into funds to buy tokens. I mean, the entire altcoin market cap is something like $250 or $200 billion if you cut off the top 10. That's really, really tiny when you compare it to equities, which are 150 trillion. So it moves very easily, and it moves down very easily when basically you have a group of people that aren't necessarily sophisticated investors and that are selling based on whatever the KOL told them to do. So at some point that will change, but I think even running a fund that we run, it's sometimes hard because the market doesn't necessarily behave like you think it would because of the retail domination.
And so what does need to change in the industry to get institutions fully on board? I mean, there's obviously a hesitancy, a lot of misunderstandings about what it is, but also some really fair criticism. So in your mind, what needs to be stamped out of the industry before it can fully mature?
I mean, bad behavior, number one. I mean, you have open bragging about insider trading recently on Libra, for example, right? Things like that. Just if you're running an Insto book or you're a CIO at a super fund, you're not going to allocate money to a space that behavior is happening. So that's first and foremost. And I don't think any three of us are pro-regulatory guys, but you kind of need some regulation in this space to actually do something if people start to behave poorly. And you saw that in equity markets. I spent a long time in commodities, and in the 80s, you could go and insider trade off a core that you drilled in WA, and you could make money. You'd go call your brokers the first call you made, and 2 weeks later, the news comes out, and that's been stamped out of the industry. And I think we're doing that now. There's no consequences for behaving poorly. The guy that launched a Libra coin, what's happened to him? Absolutely nothing. But even Trump launched his own meme coin, and that was viewed very poorly by the space. So you're having some of the activity needs to be stamped out. Will regulation do that? I'm not sure. I mean, maybe you have a U.S. market where you have a Coinbase, or Australia where you have independent reserve, and you have effectively premium exchanges, and you'll have tokens listed on these exchanges, and they've effectively been vetted. So instos feel comfortable buying those tokens. But then you have all the other, hopefully no one works for MEXC or any of the other Asian non-KYC exchanges, but those guys will continue to probably list the tokens that are a little bit more dodgy, and I don't know if that ever changes. I think you probably over time have a bifurcated market, and where instos will only feel comfortable buying a top 50 that's got credibility.
Yeah, no, all true, but even. Like, you look at the hacks that are still going on in the space, you open the paper and it's meme coins. Like, how are we supposed to be taken seriously with this stuff going on? And, we've written a DDQ for our fund. Do you have insurance if you get hacked? Not available, not possible. Like, talk to us about your custodians. Do you see risks in them? Yes, every single one of them has issues, right down to the fact that, facial recognition is now the number one, way of getting into or out of an account. And yet 95% of our lives are watched from video cameras in every city that we're looking at, and it's all facial recognition that they're trying to build. Like the biometric database that the government has on you, they could actually field a call with an AI today and take your account tomorrow if they wanted to, and yet nobody seems to care, And so, like, me and Mark talk about this all the time. It's like, we don't have a custodian that we don't think we could hack. So why would an institution put money into this space? Well, that's still the case. It's very difficult. From our side, we still debate that a lot. And what we try and do is make sure that we've thought about it. We try and separate risk, and we try and write up all that documentation so that we at least identify those risks and at least are honest about how we're mitigating it. But At the same time, until we can categorically say we are insured in the event that one of these risks get actually exploited, there's not much we can do from an institutional standpoint to take that money on.
So I think like Fit 21 or Fit 121 was the 121, the first pass at some legislation, which is, I think, will get passed later on in the year. You raised some good points, and I hadn't even thought about the facial recognition, the biometric stuff. But Real Vision is a platform that's used by institutions and retail, and so when I'm talking to the customers, or members, it's both. And the general sense amongst the retail community is they're sick of getting rinsed, which is there is no investor protections when coins come onto the market. Lockups, the amount of insiders that have coins, what they can do with those coins, most of them are actually selling them, from locked wallets or locked positions. There's all sorts of stuff that goes on. And also just they're not being priced for success because the VC's objective is to get it as high as possible so they can dump. So equities doesn't work like that. Like Morgan Stanley, well, I was going to say Credit Suisse, rest in peace. But all the other investment banks, their KPI is make sure that the IPO lists well and does well. That doesn't exist. So Fit 121 might not be perfect, but looking at what's the definition of decentralized, does it have a low threshold for insider or centralized control so that these protocols can live up to their name, right, rather than just be monikers in name only, and actually behave where it's public ownership of public assets with small insiders priced when they list at an objective level which succeeds, and disclosures. If you're not sufficiently decentralized, you have to provide some sort of disclosure to some sort of authority in the same way as equities do when they are listed on any given exchange. So I think that's a big thing, and because the dereliction of duties by regulators and governments have left the degens to basically corner this market and turn it into a circus, is hopefully going to go away once we've got constructive regulations, because we do know that tokenizing financial assets and moving them on blockchain rails is going to unlock a huge amount of productivity, a huge amount of growth, and be so beneficial for the end consumer. But at the moment, instead of it being financial assets from traditional world, it's just this circular economy of degen meme coins and shit coins and NFTs and all this sort of stuff, which, some of it has value, no doubt. But I mean, it's when sort of the adults come into the room, hopefully through some constructive regulations, that all of this just becomes a thing of the past, hopefully.
Great, thanks for the insights. So I'll come back to the panel in a few minutes to just get a quick wrap up of where they expect markets to go. But I'll open it up to the floor now for Q&A. If anyone's got any burning questions, no topic is off limits, or maybe some are off limits. But does anyone have any questions?
How far off are we from being able to get insurance?
No clue. Seriously, yeah. Like it'll be regulation insurance that'll be required, but yeah, like we're constantly knocking on doors, and the answer is, well, I would say over the last 18 months, the answer has been, I don't even want to talk to you, and now they'll answer the phone, and it's maybe, but we go to a lot of dinners and try and speak to a lot of regulatory consultants, and the answer for them is, it's coming, we're making headway, but you never actually see a politician care. Interestingly, we were at a different exchange's dinner a couple of weeks ago. Wasn't, I'll say, Independent Reserve, so I'll give you a plug. But their regulatory guy was talking, and it was super interesting in that the Labor government have discovered that something like 80% of crypto owners in Australia are Labor voters. I don't know whether that's real or not real. It seems kind of too high for me, but let's pretend that that's half right, and it's actually they've figured out that there's 3 million people and most of them are Labor voters. Don't know why you don't make it a policy and why you don't lead with that as a front foot on how to get regulation through. But yeah, it's just not forthcoming and it's not clear, that's for sure.
Any other questions?
Great.
You talked about the refinancing cliff coming. Are there any signs that it might be going the way of not being able to refinance?
I guess I'm not seeing anything. I mean, the question is not will they be able to refinance this, is at what level?
Yeah.
So they're doing their darndest by the looks of it to get the best possible rate. It'll be obvious in treasury volatility, the move index. It'll start, if there is major concerns bubbling up in the market, it'll be expressed through the dollar and the move index. So like consumer confidence and all that thing, that's like the real economy, right? And then there's the financial economy. So they will start expressing it through various instruments. It'll be the dollar and the move index. I have this belief that they're trying to do as much as possible, so the central bank doesn't have to do as much as possible. But the central bank is their bitch, right? And at the end of the day, they will do the bidding of the US government and will step in if there is a disorderly treasury market. If there is a disorderly treasury market, Bitcoin and everything is lower, like considerably lower. But I feel that the Fed sees themselves as the arbiter of an orderly treasury market, and they will do their darndest to ensure that it happens. It may just be that the US doesn't get their way at the level or the interest rate on the debt that they issue. But I haven't seen anything to suggest that it's going to be disorderly just yet.
It's a great question, and it's petrifying if it happens. The Fed is backstopping the duration issue that all the banks have in the US, in that they all bought these really low-cost bonds or low-yielding bonds, and then all of a sudden they all have a duration issue in terms of you had 10% deposits and a whole host of 4 or 5 year treasuries. You can't actually term them out. So the Fed, I can't remember what the number is, but it's billions and billions of dollars, tens of billions of dollars, maybe it's hundreds of billions of dollars, sorry, but it's a huge issue. And if I'm Trump and I'm looking at the Fed and I haven't been able to accomplish my goal, I'm going to yank their ability to hold them and term that duration issue out and just have an issue with the banks in the US. I think you'll watch credit spreads for that, probably. You have seen a big rise in credit spreads from the AAAs to the BBBs already in the last handful of weeks, because that actually is what probably changed our 4-year cycle when Silvergate and Signature went down, because there was a huge amount of outflows, and the Fed stepped in and said, we'll just buy every single bond that you have on your balance sheet that's got a duration issue. And so you really don't have any type or any potential for a credit event unless the scenario that you talk about happens and that hole gets bigger.
Following on from that question, the strategic reserve and the time it takes to be legislated. How might that be affected by the US's ability to refinance?
So are you asking how will the strategic reserve kind of be impacted by potentially not being able to refi, or they've already announced what they're going to do with strategic reserve. They're not going to buy anything new. They're just going to take anything confiscated and put it into the street, and who knows what happens. And that needs to be hopefully legislated. There was a bill going through already that was put forward almost a year ago by a senator in Wyoming to make that formal, right, instead of just a executive order. I think what's more interesting and I'll let you guys answer how that, I mean, if the treasury market is able to refinance, Bitcoin's doomed along with everything else. So I think we'll just answer it that way. But the sovereign wealth fund is more interesting. I mean, the U.S. has never had a sovereign wealth fund. So, Middle East is very common, right? The other countries, it's all over. But I mean, that's where it's a bit ambiguous if they can own altcoins. So if you could own, Trump likes to pump SUI, for example. Like you could easily see, and the guys who are involved in the 24-person committee, that's Cardano and some of the dinosaur coins. And you could easily see the top 20 being held in a sovereign wealth fund under a Trump guided. It'll be really interesting to see if that happens. But the first step is to get that sovereign wealth fund legislated so that they actually can go ahead and potentially, buy altcoins in a sovereign wealth fund. To be.
The other thing I'll add is you've had Europe come out, or a handful of European nations come out and say that the strategic Bitcoin reserve is a threat to their security, and the credit ratings of the US should be downgraded because they're potentially moving into Bitcoin. Now, I don't know what that means or where that goes, but it's just a tit-for-tat trade debate that people are going at. You've got a lot of left-leaning governments, socialist-centered, versus Trump, who's very right-wing and looking to deal with left-wing governments in that way. And so it'll be really interesting to see if they actually follow through there, if they can, if rating agencies globally end up changing their mind on US ratings because they're establishing a Bitcoin reserve. If there's any truth to that, which I don't know, but you're not going to buy any more Bitcoin in that thing. You're going to confiscate for sure and stock it away, and it's important for your voters, but you know, it's not high on your priority list relative to the other things you're dealing with.
Good. I'll just add, like I haven't done enough work on this, but there was something floating around with the idea of Bitcoin-backed treasury bonds recently. So I'm sort of oscillate on the whole idea of a strategic reserve owned by a national government or the US government specifically for various reasons. But the idea that if the world steps away from buying treasuries and the buyer of treasuries, the last resort, is the central bank, maybe Bitcoin-backed treasuries is a way to entice buyers to actually buy treasuries if there is a Bitcoin element to it, and that would potentially increase, the private sector to buy treasuries where governments are receding. So I just think it's an interesting idea. I haven't looked into it in a great deal, but that has something that's floated in the last couple of months.
Okay, well, we've run a few minutes over time, so we might wrap it up there. But if you can just sort of quickly, in a sentence or two, give us your view on what to expect for the months and year ahead, that'd be great.
Up only. No, yeah, I'm very hopeful that the consumer has a weak year, not a horrible year. I think that the leading indicators on inflation are that we will be lower before year end or by year end. And we'll see a gradual shift in Fed policy from what I think is overly tight to a looser 2.5% to 3.5% range by year end. And in that environment, I think it's very, very accommodative for digital assets.
Yeah, I think it's because of the two main forces at play, the macro liquidity environment and also just the adoption of blockchains for use cases in traditional finance or traditional finance using blockchain infrastructure rails. I'm very bullish long term. It just comes down to really position size. So it's an incredibly volatile asset. So as long as your position size makes sense in terms of that volatility, then it's really a park and just forget to a certain degree. Put it with managers who actually can ascertain like where the value is in the altcoin space. But Bitcoin and some of the top coins, I think, over the next several years will do absolutely fine. It never feels like that when you're going through a crunching, wouldn't say bear market. Well, it is a bear market in alts, but the long-term thesis is extremely strong, and you've got all the tailwinds happening, regulations, and we've talked about it ad nauseum. So yeah, very bullish.
They've covered the macro, and they're much better at it than me. And as much as we've tried to will the analysis to tell us that its fundamentals work or there's more to it adoption, it is truly is a macro trade. But arguably, you've been punished for using fundamentals to analyze coins. If you think about what was rewarded over the last 9 to 6 months, and it's just kind of fallen off a cliff, pump fund. But Luke and I, we're not. I'm in my 40s. Luke's about to be 40. I don't know. We were getting tips from 23-year-olds that like Fartcoin, for example. I knew there's a guy that I'm in a group in the States. He told me to buy Fartcoin at 5 cents. It went to over $2. I didn't buy Fartcoin because I'm in my mid 40s. Everyone's like, what the hell is Fartcoin? Who's going to buy that? Well, that kind of nonsense. And I've seen lists where, you've got lists of coins, like you're not going to repeat in the room, but those were the most trending thing. That has to all go away. And then, so again, going back to my fundamentals point, we're sitting here using our, what we learned over 20 plus years each, and that just wasn't working. the hope is that kind of as some sanity returns and maybe it's a more regular market and pump fund isn't taking all the liquidity and that starts to work. And I think, at least from our perspective, we've got a good portfolio that look good fundamentally, but haven't been rewarded from a price perspective. So hopefully that returns here in the near term.
Well, please join me in thanking the panelists for their time today. I hope that was useful. We've got still some on the bar tab. We've got food coming, canapes, so stick around and have a chat, meet someone new. Thanks.